Namaste, Sat Sri Akal and Adab. Today is 31st of May 2024 and we are shooting this interview one-on-one with Mr. Bond in conversation with. Earlier, I have interviewed him as fund manager of large and mid-cap and flexi-cap of Motilal Oswal. Today, I have the privilege of interviewing him as a chief investment officer of Motilal Oswal Equity. What we are going to do is then discuss his various topics. It's very interesting when I get Niket in my studio. I always like to ask him many questions, not necessarily only scheme-specific questions. Of course, the climate is heating up both politically as well as, in terms of weather. We are at 52 degrees in Delhi and election results are around the corner. So we will asking about the election results and its impact for the investors. We will asking about the India growth story, some of the themes which are there in the India growth story, how they are very nicely blending with the themes of Motilal Oswal as an AMC. What are the market caps which they should be invested in so that we can capture the India growth story? And finally, of course, as usual, I have this habit of asking him global macro factors also and the geopolitical issues also. So welcome, Niket.
Thanks, Mr. Bond, for having me on your show.
Not at all. It's always a pleasure to have you on the show. We have had some very, very interesting conversations in the past also. And congratulations once again for being a Chief Investment Officer of Motilal Oswal AMC.
Thank you.
So tell me, Niket, this is the topic of conversation and the VIX is also going up and down based on the market expectations of 300 par or 400 par. Now, does that have any impact for the investors? Because if we draw an analogy of 2004 and a parallel to that, NDA was removed and Congress came to power. Markets corrected by 20% on one single day, but the best markets delivered the best returns from 2004 to 2008. So my specific question is, does the dispensation of existing incumbency and the existing government going out of power and somebody else coming into power, or whether it's going to be 300 seats or 400 seats, does that make any impact for the investors? And if at all, how much?
Yeah, so I think, two things. First, I think, whether the existing government gets a 300 or a 400 seat. For example, if they get, say, 272 or 275 seats, right, which is the borderline number as such on a standalone BJP basis, does it have any material impact to equity markets? The answer is no. Will it have a short-term impact to equity markets? The answer is yes. Depends on how people are positioned. I think the market is clearly factoring in today that the existing government will come to power. Now, if it comes with more than 400 seats together as an NDA, market will celebrate for sure. If they don't come with 400 seats, I think still market will obviously celebrate as such, because the fact that he's coming to power is far more important than in terms of what number of seats he's going to come with at this point in time. And I think I have been in US and Singapore of late, kind of meeting a lot of investors, companies, both of them. And I've realized that a lot of people are waiting on the sidelines in anticipation of clarity coming in. So I think for external investors, FIS specifically, the focus is, ensuring that he comes back to power. The existing government and the existing prime minister comes to power. They're not very worried about number of seats. And I think it's a bit of a much more discussion topic internally within domestic India as such, that whether it is 340, 330, and there are different math going around it on, different states as such. My sense is large part of that is only noise pollution, right?
So basically the FIRs look at stability and continuation of policies from the government.
Absolutely. So they are more than happy if they are more than 272. That is essentially how we also look at it, whether they get 340, 330, 400. Honestly, we don't spend time on it. We only look at that whether there is stability at the center, which is likely to come. If that's likely to come, I think beyond 1 or 2 days of movement either side, I think broadly what they are going to deliver in terms of reforms really takes the center stage, because we don't invest for 2 days or 3 days, right?
Absolutely.
It's for 3 to 5 years. So whatever happens in those couple of days, after the election, maybe till 6th of June, I think everything will kind of get settled up. Whatever has to get factored in will get factored in. And then from there on, it is just the performance of reforms and performance of the government which will really take the call on markets. So I don't think one has to really think a lot about the number of seats. What you have to think is, are they coming to power or they're not coming to power? If they're coming to power, let's focus on the reform part of it and cut rest of the noise.
Absolutely. So let's cut out the noise and then concentrate on how the continuity of reforms will happen. And fortunately, India is currently in a mini Goldilocks moment. Macroeconomic conditions, healthy corporate earnings, peaking of interest rates, moderate inflation print, and policy momentum all are driving the growth. So if you see from 2014 to 2024, we were ranked 10th in terms of the GDP. We are ranked 5th now. CAD was at 1.7%, we are at 0.7%, which is phenomenal in spite of all these geopolitical issues and corona, etc., etc. Market cap, which was 1.2 trillion, is at 4.4 trillion. Market cap in terms of the ranking, global ranking, we were 11th, we are at 5th now. And the earnings growth was 10%, we are at 22% currently. So do you agree that this mini Goldilocks period is there for India, and that this India growth story will continue to drive the world engine also?
I think so, Sunil. Yes, this is definitely going to drive. I think all the data that you just mentioned in terms of nominal GDP growth, flows, growth rate of earnings. I think what we have generally believed internally is that what we have seen in the last 3 years is just a trailer, right? The movie is about to start.
Absolutely.
We strongly believe that if you look at last 5 years, right, the growth rates of, earnings growth have been about 22% for Nifty companies, and mid cap has been about 36%. Now, if you bisect and dissect of that 5 year, the first almost 1.5 year went in COVID, right?
Correct.
A large part of the earnings growth is only in the
After
preceding
2021, I would presume.
right? So just 3 years effectively, right, in some fashion.
Correct.
And in 3 years, we have done so well that actually the 5 year looks very good.
Yes.
Right? And I don't think at any point of time the momentum is slowing down at all, right? From an earnings growth standpoint. We might have quarters of low earnings growth, quarters of high earnings growth, but on an average, I think we will still deliver more than 15% earnings growth, at least on a sustainable basis for the next 5 years on large cap, and about 18 to 20% on the mid cap side. Till the time we have similar kind of earnings growth, which I talked about, I think broadly, give or take plus 2% or plus 3% should be the market return. Right.
So our honorable Prime Minister's, vision of 2047 at 9.5%, nominal GDP growth from the current levels, we can go to $30 trillion by 2047. Is that correct?
That's correct. That's completely correct.
So that's a very doable number, right? 9.5%.
That's an absolutely doable number. 9.5% nominal GDP growth is a very conservative number. Our view is that we should see a more than 8% GDP, real GDP growth rate number for the next 5 years, which at least in the last 15, 20 years, India has not seen a 5 year duration where you see more than 8% GDP growth number on real GDP terms. It also depends on inflation and nominal, but I think nominal will grow at a rapid pace. Inflation will be under control. And hence, I think on an aggregate basis, we will see more than 8% kind of a real GDP number as such, which I think will be a phenomenal task given given where the world is right now.
Absolutely. 6.5% and 8%, what you are saying in the real GDP growth, definitely India will be the shining story. Yeah. Now tell me, India's dependence on exports is lower than the rest of the countries, but dependence on global economy is also low, thereby having very minimal impact due to global macro meltdowns or geopolitical issues. And India's attractiveness in such a scenario will actually go up if there is a global meltdown rather. And weightage of India in MSCI emerging market index has gone up from 18.5% to likely to go currently at 18.5% and likely to cross 20% also. Plus, the number of stocks have also increased from 136 to almost 150. All these are extremely positive as far as the India growth story is concerned, and it's decoupling from the rest of the globe. But of course, if US sneezes, China sneezes, there will be some kind of an impact, but not as much impact as somebody who's so dependent on the global macros.
Absolutely. So I think it's a good point that you made. If you look at where India is standing today, look at our current account deficit number, right? And we've just begun our Make in India, journey, right? And we still have semiconductor to come. We still have mobile component manufacturing to really ramp up in a big way. We're still developing an Apple ecosystem in India. That can be a large size opportunity. I would not be surprised if our current account deficit number goes the similar way that it actually happened with China from 2008 to 2015-16 duration, where China did very well. in terms of the economic growth as such. I think India will be in that similar journey. Broadly, most of the steps that we see that Indian government currently takes in terms of, first developing a large ecosystem within India, then moving to export market is what even China did in those years. The second important point is on the point that you alluded on earnings growth, right? So I think our view is that if you look at India itself, there is a finite size of opportunity within India, but I think now in the time has really come for India to manufacture for India and also for the world, right? Which is how
Correct.
size and scale really comes through. And I think we should definitely see that happening in the next 5 years. If you look at the BJP manifesto, I think there are various areas this time in the manifesto which clearly highlighted that their focus is big time on exports, right? So export of shipbuilding, making India a hub for shipbuilding, export of rail, export of defense, export of semiconductor. I think you will see export as a very large center theme
It's
playing
a
out.
huge positive for the CAD.
It's huge positive for the CAD. Now, if you look at from a global GDP growth rate standpoint, US is slowing down. We saw that in the last quarter. And if you look at Europe, Japan, all of them have been slowing down. China is reasonably growing, even I would say mid single digit rate, which is also not bad given the valuations where they are. So clearly, from a standout performance, I think it's India.
So as we discussed, during this from 2014 to let's dissect that as the first 5 years of Modi and second 5 years of Modi. So we grew at 10.1% from 2014 to 2019. But we actually grew at 14.2% from 2019 to 2024, in spite of COVID as a stumbling block in between. So we've done very well in spite of these issues, geopolitical issues and otherwise also. So you think that the continuity of policies has borne the fruits from the first five to the next five, and that will again bear fruits in the coming 5 years if they come back to power?
Absolutely. So I think if you look at, before answering that question, let me give you another analogy, right? If you look at earnings growth of India for Nifty companies was almost 25% from 2004 to 2008, which we call as a bull market that we all recollect of.
Correct.
And earnings growth for mid-cap companies at that time was also 25, 26%. And return of market was, 27, 28% CAGR in that
Similar,
duration,
yeah.
right? And then came the 10-year block or a 12-year block from 2009 onwards all the way to 2021, where Nifty earnings was only 5% growth.
Absolutely.
Cap was 6% growth and return was also 7-8% CAGR. Right now, we are seeing a situation where earnings growth is moved back to 22%, mid-cap earnings growth for the index 36%, and return are again 2-3% higher than the index growth, index
Correct.
earnings. So what is the correlation here? The correlation is that in the first 5 years of Modi government, the earnings growth was 7-8%. So return was 10. Then in the next 5 years, the earnings was much higher and the return is 14 because we had two bad years, right? When there was,
Correct.
if you take the 3-year period of that 2019 to 2024, if you take a 3-year period, earnings growth was 22% and return was 25, 26%. Right?
Absolutely. Now let's talk about where can we capture this story of India growth story. So SEBI categorization of large, mid, small caps, etc. is there. But if you see the multi-cap which we are going to be launching, the NFO which is coming up, so large cap you have to be minimum 25%, mid cap you have to be minimum 25%, and small cap also minimum 25%. So this India story, growth story, is actually cannot be captured only in the large cap, only in the mid cap, or only in the small cap. So naturally, the multi-cap story resonates well in the current scenario. Am I correct? Because large caps is where the mature. It's basically what we call the elephants with size and scale, where it's a mature phase, market leader, stable growth, capacity to invest, scale and diversify, highest institutional ownership. So first, let's talk about the large cap, then we'll go to mid and the small caps also.
Right. So I think if you look at the entire India story, the large part of the India story today from a growth, why does anyone come to India? It's just primarily for growth, right? Higher growth than most of the other markets. Now, where is the higher growth within India? The higher growth really lies in mid and small cap space, right? At the same time, what is also important that we need a stability of a large cap. And then we really focus on high growth on the mid and the small cap side. Now, when the economy actually grows at 8% plus on a higher base, it means that it is not driven by one sector or one fraction of the segment of the society or segment of the earnings growth as such. It's much more broad based. Only then you will see 8% kind of earnings growth, right? Otherwise, it's very difficult to get a 8-9% kind of a real GDP growth rate and expect only one segment of the market to do very well. It really doesn't work that way. So our view is that you will see incrementally the market being more broad based, which we have seen in the last 3 years. Look at sectors like defense, rail. No one used to talk about it if you look at pre-COVID, no one used to talk about it. Now they
Correct.
have become darlings of the street, right? And
So
it's all
these are
driven
all
by
Atmanirbhar sectors, basically.
Atmanirbhar sectors, and they're all driven by earnings growth, right? It's not that
Correct.
they're not showing earnings growth. All of them have been driven by earnings growth. Look at power as a sector has come back with a vengeance. So the market has become much more broad based. And when the market becomes broad based, I think mid cap and small cap is where the earnings growth really lies. And you obviously get with the benefit of the large cap in terms of stability as well. So if you want to play the entire India growth story across market caps, then I think multi-cap is the best option where there's 25% allocation compulsory to be done on large, 25 to mid, and 25 to small. The way we also internally look at is that we want to make this as our house best stocks portfolio, right? All our highest conviction ideas on large, mid, and small will be a part of the portfolio.
Wow. Okay. But where will you be overweight at the current juncture? Will you be overweight mid and small, or will you be overweight in large? Because you
I
have
think
that
if you
leeway of 25% extra.
Sure. I think if you, broadly, if you look at we don't keep it at 25%, it's just too close to the ceiling.
Yeah,
And
because
hence,
plus minus valuation will happen. So
correct. So we will any which ways go with 28% each to start with, right? To ensure there's
right.
enough more cushion, right?
So now let us talk about the mid cap story. The mid cap is basically what we call the tigers on the prowl. Wealth creation stage, high and sustainable growth, established track record, challenges to large companies, mainstay at most profitable, and they command a premium, and naturally increasing institutional ownership also. And the small caps, the way we portray them is the cheetahs with a bold moves. Companies in emerging business, promoter-driven companies could be leaders in their space, high growth, high re-rating, large investable universe, and fund managers playground. So if you can just throw some light on these two aspects of mid and small caps.
Small cap side, our endeavor has always been to find the small cap which can become potential large cap and find the mid cap which can become potential large cap, right? So that's where
No,
the
so
value creation is.
the in the eyes of the investors, small cap is basically a very volatile space, etc., etc.
Right.
Because earlier the small caps were literally small cap, but now some of the small caps are bigger than some of the large caps which used to be there maybe 5 or 10 years back. So if
Yes.
you can throw some light on why small cap is also not as volatile as what they used to be for the sheer size of what the small caps are now.
Correct. So today, if you look at above anything above 75,000 crores is large cap, between 25,000 to 75,000 crores is mid cap,
Mid
and
cap.
less than 25,000 crores is small cap. Now, if you look at the less than 25,000 crore market segment, say an average of about 12,500 crores, right, as a sweet spot of the company is concerned, and if you give a 30 times multiple, to earnings on a conservative basis, depending on again sector to sector, but let's take a blanket of 30 time earning, it effectively means that some of those small caps will have profitability of more than 300, 400 crores,
Wow.
right? So they will have capability to ensure that they are less volatile in a downturn environment. They either will be leaders in a particular segment or they will be the number two guy in a particular segment. But their balance sheet and profitability is large enough to ensure that you don't see near-term shocks, given given how volatile environment we are right now as far as the world is concerned.
So basically, and plus, I think it's the QGLP also, which will add a further layer to it. Then you will remove the, the those which are at the bottom of the table in because small cap universe is huge and large. That's the largest universe, as I said. Now tell me, high growth potential leaders in current market cycle. Some of the house themes which are there is healthcare, financialization, tech and tech services, China plus, Make in India, urbanization. So all these are ideally there only in the mid cap and the small caps, and very limited space or representation in the large cap space. So if you can talk about your house themes and how they are being represented in the mid and the small caps, and that's the reason why you're going to be more overweight in the mid cap space.
So if
And
you
this
look
is
at
all, sorry, these are all part of the India growth story. So they are all gelling together.
right. So even if you look at, say, hospital as a theme, right? Obviously, it's largely played through the mid cap space with a couple of mid cap hospitals growing at a faster pace than the large cap hospital names. Again, within the NBFC space, we believe the size of opportunity is very, very large. You have a few large caps to play there, very few mid caps to really go and play with. But yeah, large caps is where there is real alpha to be created as far as NBFC is concerned, because I think entire BFSI space is all about scale, right? More the
Correct.
scale, you have become more powerful as such. The third is consumer discretionary spend. I think we clearly believe some of the mid cap and small cap names of today will become, the large cap names of future in the consumer discretionary space. We do have consumer discretionary or the platform businesses within the large cap space where we still expect, like, some of the food delivery business, we do expect 40-50% kind of earnings growth to sustain for the next 2 to 3 year period. Even within the consumer discretionary space, we have some jewelry guys which are mid-cap companies growing at 35-40%, even on a reasonably larger base. So we do see a lot of companies on the consumer discretionary side, on the mid-cap and on the large cap side, where we still believe the growth rates are likely to be fairly higher with, again, large size of opportunity. Last but not the least is IT. I think we are clearly seeing mid-cap IT doing far better than large-cap IT in terms of growth rate, and it's also visible in stock price. And I think we will continue with that same mindset that we will go overweight on mid-cap IT versus, I would say, large-cap IT. So clearly from that standpoint, I think mid-cap is where the real juice lies as far as IT is concerned, and to some extent small-cap as well. So I think that's how broadly we will, bisect between mid, small, large as far as themes is concerned. I think banking is where we focus on large cap, but I think most of the others is where mid cap and small cap become.
Perfect. So what we've done is, Niket, we've covered the India growth story, Motilal Oswal house themes also, and how they are complementing with the India growth story. Now let us dwell a little bit on the market valuations currently, because people are saying that markets are at an all-time high. So if we can just throw some light on the market valuation, but some of the points which we have made is that number one is the high growth period with small and mid cap earnings outperforming large caps, led by healthier balance sheets, including the NBFCs and the banks also. Valuations are sustainable and increase in corporate profit to GDP. So if we are able to talk on each one of these aspects, how will you? Let's start with high growth period for small and mid caps.
So I think, two things have happened right now as far as India is concerned. One is, I think, again, high growth period for mid and small. It's also driven by how the broader market has performed. Across sectors today, we are seeing growth coming in. So it's not led by one particular sector. It's been across sectors, and large part of that sector is a part of the mid cap and the small cap space, and which is visible in the high growth that you are seeing right now. What is other important point is that one thing which India has done differently this time is ensure that the balance sheet of the entire corporate India, including banks, is very, very strong. So
Very strong.
So debt to equity for corporate India is actually a 15-year low. Free
Wow.
cash flow generation in this year is highest ever in 15 years. Right? Free cash flow essentially is cash flow after capex, and the money which is essentially left to reduce debt, or you can give a high dividend or buyback as such. But large part of corporate India has reduced leverage recently. And we clearly see that trend playing out across sectors. So it's not a specific thing to a particular sector. It's across sectors. So the balance sheet is strong. Earnings growth is extremely strong. Obviously, if your balance sheet debt comes off, your interest cost also comes down by every passing year, which only helps you to grow faster. So I think we are seeing some of these clear trends being playing out. Now, in terms of valuation, I think if you look at Nifty, broadly, Nifty trades at about close to 20 times on 1 year forward basis. The 10-year average for Nifty is about 21 times, right? So we are still about 5% cheaper than the longer term averages, even when the growth is higher.
Okay.
If you look at mid caps, today are trading at 7 to 8% higher valuation. Even for small cap, they're trading at 8 to 10% higher valuation than what they used to trade on a 10-year average basis, right? So we are seeing record high growth rates, which is the reason why you are seeing valuation being premium to a longer term average. And hence, I think if the growth rate will sustain in terms of earnings growth, the valuation will also sustain around current levels.
You pointed this out very beautifully earlier also, that 2003 to 2008. So we are basically in the midst of a bull run, which is similar to 2003 to 2008, where the earnings growth of Nifty 50 was 25%, your mid cap was at 25%, and your small cap was at 33%. Then, of course, there was a lull in earnings growth of Nifty 50 mid cap and small cap also, which came down to 5.1%, 4.2 to 2.8%. But all of a sudden, in the last 3 years period, they've jumped up. All of them have jumped up from 22% to almost 48%. Now, tell me, this trend is sustainable going forward also? This earnings growth trend?
Yeah, I think, if you look at last 3 years of mid cap at 36%, I don't think with that number is likely to be 36% for the next 5 years, right? It will be
Sure.
obviously lower. But what is the right number to really look at? I think the right number to look at is anywhere between 17 to 20% earnings growth
Okay. In
for
mid
the mid cap
caps.
space, right? For the mid cap. For small cap, it will again be broadly similar. In terms of small cap as well, you should see broadly about 18 to 20% kind of earnings growth for mid and small. For Nifty, I think against the 22% that we've delivered, we should see broadly about 15 to 17% earnings growth. We also have to keep in mind that the base effect also tends to play out, right? And growing at 15% on a higher base is absolutely phenomenal.
Yeah, that is
It's
very
not a bad
important
growth.
because you are talking about higher base, much higher base, and then
Much higher
15%
base
of that.
and on a stronger base of last 3 years deliverable number, right? So
Correct,
I
correct.
think you will see a few years of at least the next 1 or 2 years of 15 to 17% for large cap and about 18 to 20% for mid and small before most of the measure that the government is going to take now will really start firing up all cylinders, in the second half of their, journey from now. So again, the second half of this 5 year duration, in our opinion, should again be higher growth the way we have generally seen in the last 5 years as well.
And the other thing which you mentioned also was, the corporate debt to equity is down. ROE on listed companies is at 15% financial year 2024, and corporate profits to GDP is also at an all-time high, practically at 6.5%.
Right.
So these are also the macro,
Yes.
factors which will play out in terms of the market valuations going forward, which are sustainable as what we've just discussed.
Sure. So I think if you look at ROE, I think we're back to 15% after a long stint, almost been a decade that we've gone to 15% ROE, and also led by banking. Banking ROEs have also moved up because profitability has been much stronger with lower credit cost. If you look at most of the other sectors and other corporates also, ROEs have moved up because if your interest rate, I mean, if your debt comes down, a lot of companies are now become debt free, are actually paying out higher dividends, and paying out higher dividend also pulls up the ROE as such. So I think when ROE tends to move up, we definitely see valuation re-rating happening in individual stocks, and it's also true for index as such. And I think we should see that continuing, right? So can we move from 15% ROA to say 16 or 17%? My answer is it is possible that we might gain another 100 basis points of ROE, at least in the next, a couple of years from here. From
This
where we
is
are.
purely on the fundamental side we were discussing. We're not even talking about the liquidity which is going to be infused post the elections.
Correct.
Am I right?
So this is on the fundamental side, and this is at the time when the interest rates are extremely high, right?
Absolutely.
If interest rates
And
starts
we are
coming
at
down, it
peak of the
benefits
interest rates,
profit.
and from here we can only go down.
We will only see higher profit after tax, but then only pulls up the ROE as such.
Correct, correct.
And similarly is also witnessed in corporate profit, right? I mean, a large part of the ROE as well as earnings was also reflected in corporate profit as a percent of GDP, which is now touching closer to 6%. Something which we have seen again in the a decade back is now coming back at us. Now this 6, if you look at in 2004 to 2008 cycle, was above 6, right? Is in fact gone above 7 as well.
Right.
So we still have some room to do that, to better that number what we have already achieved in the last 2-3 years. But I think in the last 2-3 years we've definitely revived the animal spirits. Typically the government tends to spend first, generates more confidence in the economy, and then that's followed by private capex. We are seeing early signs of private capex picking up, and I think once the government and private part of the market both fires together, then I think you will see the magic that we are
So
really
it's a
talking about.
single engine versus the double engine.
Correct. Absolutely.
Right?
Absolutely.
Okay, now since we are discussing about similarities between 2002 to 2008 in terms of the bull market period, during that period markets had gone up almost six times, 6x, delivering a 33% CAGR. Currently, if you see the bull market from 2020, January 2020 to now, we've done about 15%. So is that some kind of a precursor to say that, or can we take some analogy forward and say that there is some further room to go up to maybe 30% also? Because the macro factors, the fundamental factors, the earnings growth factors, everything is something similar to 2002 to 2008.
I would definitely say that this time is going to be much more bigger and better. This time it's not going to be smaller than 6.2 or 6.3 times the return that we saw, because I think the real breaks were in 2008, right? Because of which the party ended.
All that is very, very good. Now let's talk about the global factors and the geopolitical issues, which are, the major factors, according to me, which can, spoil the party is the CNC, the two C's, the cash flows, which are the liquidity coming into the system from FIs and FDIs, and the crude. These are the two important factors. Because of the geopolitical issues, they are both in question mark currently. So your thoughts on that, and of course other factors which are the Indian election outcome. First of all, that's around the corner, just 4 days ahead. Then the budget. What do you expect in the budget? Are we expecting anything negative in the budget? Then the November 2024 US elections, December 2024 US economic data and its impact in the global scenario, geopolitical issues, and then CNC. So these are the factors which are the global factors and the geopolitical issues, and of course the election related issues both in India as well as abroad. So your thoughts on
so I think if you look at from a flow standpoint, right, historically, I know as a matter of fact, if you go back 10 years back, FI shareholding in India or Indian listed companies used to be about 23%, right, which is down to 16% on a higher base, right, over a 10-year period. So, and I always joke internally about this, that the 16 we worry disproportionately about the 16% guys selling and going out of the country, but we underdetermine the power of that 84%, which is going to really keep buying. And we're seeing that in SIP flows, we're seeing that
which is
in a lot
happening.
of NFO subscription that is now happening at this point in time. So I think the retail investors have really woken up. The penetration of equity markets in India is still dismally lower as compared to global markets. So that 84% is not going anywhere. That 84% still has a lot of
Can only
firepower,
grow. It can
and
only
that
grow.
84% will keep growing. So if 84 stands on one side to keep buying, then I think the 16% guys to worry more than the 84%, I believe. So I don't think FIF flows. In fact, I have stopped tracking that number off late, because that really has no major impact on equity markets. In fact, the
Absolutely.
other way around really works. If the election results is favorable with the market expects, and if FIS comes to buy along
More
with the
flows.
84% which is buying, you will have an explosion out here, right? And I think the chances of that happening is far more higher. The second point that you also to keep in mind is like, which is, from an FIS standpoint, why are they selling? The reason why they have been sellers is because they have other opportunities across the world, whether it's China, Japan, Korea, and some of those markets are much more reasonable in terms of valuation as compared to our market. So from an FI standpoint, when he sells, that doesn't mean he's negative on India. It just means that he has better options somewhere else to multiply his money from a risk reward ratio standpoint, right? So I think that's the other key thing to kind of keep in mind. The third is on the crude side. Now, interestingly, again, there's so many geopolitical issues happening all the time in the world. My simple way of looking at it is that our largest I mean, if you look at the larger top five economies in the world, are they getting into a war? Or the smaller ones are getting into a war. So if the smaller ones are getting into a war, which has very negligible impact on global GDP or global trade, then it's more of noise pollution again, right? And one should really not look at that event and make a interpretation that the world will collapse or the market will collapse or crude will go to $150 or something like that, because it will not have a sustainable or a larger impact beyond a week as such, right? We generally
Right.
see some of these things dying down after 1 or 2 weeks, and then it's business as
We've
usual.
seen that with Israel, Hamas, Ukraine,
We've seen with
Russia.
Israel, Hamas.
In
You've
spite
seen
of
with
that,
Russia,
crude
Ukraine.
is still quite stable.
Yeah, we've seen with Russia, Ukraine, right? Where it
Yeah,
started,
Russia,
where the
Ukraine,
markets
sorry.
were, where the markets are right now. If someone would have thought about Russia, Ukraine and exit the market, he would be repenting it today. So
Correct.
the question to ask is, are these companies large enough? If China gets into a war with US, then I would be really worried,
China,
right?
Taiwan will have no impact.
China, Taiwan will have impact, because again, a larger economy getting into a war will definitely have an impact.
This is the NFO at the right place at the right time.
Yeah, so Sunil, fundamentally, I believe that timing has no importance in this business, right? If I to launch this product before election, my job remains the same. I have to outperform across durations.
No,
And
nothing to do with elections, but I'm saying overall,
yeah,
because of your house teams, the way they are positioned,
right.
I think you need to be in a multi-cap story. And is that the reason why you're coming out with an NFO? Because Motilal Oswal as an AMC is not just an asset gatherer. I know that. You come out with a NFO at the right place at the right time. And then, the investors benefit out of it.
Yeah, so the reason why we've launched it right now is I think two things, right? One is that if you look at the last 10 year, what the government has really done, I think there were a lot of other factors where the government energy was really channelized. But our view is that if you look at the current government, their speeches, when we interact with some of the people out there, we've generally seen in the next 5 years, the focus is only one thing, which is economic growth, economic growth, economic, right? And the best way to play economic growth is through playing through all the parts of the value chain, which is mid cap, large cap, small
Correct.
cap. And hence the NFO at this point in time, because I think the single agenda of this government is earning economic growth right
Absolutely. Thank you so much, Niket. It's always a pleasure talking to you and discussing topics of so much of varied interest. And I'm sure the viewers also will benefit out of this. Hopefully, we should be able to release this before the election results are out. And then the viewers can benefit out of the discussions which we've had so far. Thank you so much.
Absolutely.
And
Thank
all
you
the
so
best
much
for your NFO.
Thank you so much for having me here. Thank you.
Yeah.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.